Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in 45 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going, bro?
I'm very good, Bryce. Very excited for this episode.
Incredibly excited. Both of us big football fans, as our Equity Mates community would know, and it is for that reason that we cannot wait to get this episode underway. Long time in the making. Thought before we do, Ren, I'd just reveal the CV of who we're talking to because it is incredibly impressive. Former AFL player and captain of the West Coast Eagles and Carlton, dual-Brownlow medalist, 6-time All-Australian, captain of the squad in 2008, premiership captain, founder and current director of Judd, which is an Australian sports apparel company, board member of the Carlton Footy Club, podcast host, video extraordinaire, and investor in microcap listed companies. If you haven't figured it out, we have Judd joining us on the show. Thanks for joining us, Chris.
Gentlemen, very good to finally be on the show after a few technical challenges.
Yes, third time lucky. We finally got on. So as we just said, we're incredibly pumped to have you on the show and looking forward to exploring probably one of the sides that not many people know about you, which is the micro cap sort of investing in equities side of things. Everyone knows you as the football player. So yeah, thank you.
Beautiful. Looking forward to the chat.
So, Chris, we like to start these conversations with a bit of an icebreaker, a bit of a game, if you will.
Yes. It's
a game of overrated or underrated. We like to throw out some, indexes and some investing themes.
There's no neutral weighted options.
We've spoken to someone from Vanguard who said everything was fairly rated. So feel free to go down that path if you want to.
Yeah, cool.
But if you're up for it, we'll kick this off with a game.
Sounds good.
So to start with, overrated or underrated, the ASX 200?
Well, I don't have a strong view, but I don't own any stocks in it. So I'll have to say, by that definition, it's overrated to me.
I assume this will flow to the next then, overrated or underrated large cap stocks?
Yeah, I'll stick in the same boat, overrated.
Yeah.
Overrated or underrated ETFs?
Well, it depends who you are, but yeah, I don't own any, so overrated.
Do you own any gold, overrated or underrated?
Gold, underrated.
Okay, why is that?
Well, there's a huge amount of issues with fiat currencies around the world, namely countries are printing them like they're going out of fashion, and that tends to not end well whenever that's happened in history. So underrated gold.
So that answer might flow on to the next one, which is always a bit of a controversial one. Overrated or underrated Bitcoin?
Yeah, well, if people understood it better than me, I'm sure many would put it in the underrated category, the same as gold, but I don't understand it well enough. So to me, it's overrated.
Do you own any Bitcoin?
I, funnily enough, do, because I got given some as a gift.
Oh.
So my brother-in-law loves his cryptocurrencies, and I talked him out of buying a considerable amount before they went berserk, which was problematic at family gatherings for a period of time. And for my birthday, he was good enough to give me some crypto. So I do technically own a small amount, but I didn't pay for it and still don't understand it well enough to invest in it.
So overrated or underrated the Australian property market?
Well, look, I mean, sort of overrated, but gee, interest rates have never been as low as this before. So I own it and I'm pretty comfortable there, but it's also incredibly expensive when you compare it to property markets around the rest of the world.
Mm-hmm.
Now, Chris, I'm a big Sydney Swans fan, so I've got to ask it. Overrated or underrated, the Swans?
Underrated.
Oh.
Great.
Well, I'm a massive Essendon Bombers fan. Overrated or underrated, the Mighty Bombers?
Overrated.
Yeah, that's what I've been telling you.
Come on.
And then last one, you're still very heavily involved in the Carlton Footy Club. So overrated or underrated Paddy Cripps?
Underrated. Still got plenty of upside. Still a buy. Still a long buy.
You'd put your 100% of your portfolio in him.
That's right. Yep.
So, Chris, as we said at the start of the show, everyone probably knows you more for all your achievements in AFL. and probably less for what you're doing in the equities market. So are you able to take us back and talk us through your experience with your first ever investment and perhaps what was a major lesson that you learnt from that?
Yeah, so my first ever investment, I got $1,500 from the AIS AFL Academy when I was a 16-year-old, and that was a huge sum of money for a 16-year-old kid. And I remember deciding that I'd invest that in shares. So I went down to the news agency with my old man and we bought a share magazine and did some heavy due diligence working through the recommendations of that share magazine, which is an interesting way to pick stocks. And we ended up picking a stock, AWA, I think it was, which was a electronics manufacturer that I assume is no longer around. And that did well, which was just pure luck. And then we rolled that into Pasminco, which didn't go so well, which was a zinc developer at the time, and whose assets, I think, ended up being rolled into Zinifex, which now makes up part of Oz Minerals. So that was the earliest exposure to equity investing.
And so why was it that you decided to invest in shares when you had $15 as a 16-year-old? I mean, a lot of others would probably go out and buy, I don't know, the PlayStation or Xbox or something, you know.
$1,500, not $15.
Sorry,
15 would have been fairly.
How did you have that mindset to invest in stocks?
Well, I think just greed, I assume. I wanted to buy a car when I was 18 and wanted a better car than what the $1,500 would buy me. And my grandpa was a reasonably savvy investor. So I think watching him, and I reckon he bought News Corp shares when they were about 30 cents, obviously a very long time ago. So you can imagine the place that Rupert Murdoch had in his heart. So, yeah, look, I think it was that modelling, and I reckon my old man had just started a self-managed super fund at the time, so it would have been those influences that led me to think that this was an appropriate course of action.
Yeah, nice.
So, Chris, then you started your footy career, and I imagine you were extremely interested in investing during that time as well. So how did it go, trying to talk stocks in the change room and being interested in the market while you were playing footy?
Look, it was useful for some different reasons. I think what really pricked my interest was over in Western Australia. I really disliked reading about football or about me or about the clubs I was playing for. And in WA, 80% of the sporting news is about the West Coast Eagles. So I started just buying the Fin Review every day because I knew I wasn't going to stumble across any footy stories in it. So it felt like a safe space to read some news and learn some things without having to come across any footy stories. So that was really beneficial. The early stages of investing was a nice distraction from footy, and I was able to learn some basic things about business. Funny, when you first start reading business stuff, you don't understand a good chunk of what you're reading, but after a while it starts to sink in and things slowly start to make sense. And then when I was about 28, I started investing in things like BHP and ANZ and things that I don't know how anyone makes money on. And then when I was about 28, I met a guy who's a really savvy small cap investor who's also ultra private, so we might just refer to him as the chair for now. Nice. And he really helped me, I guess, formulate the strategy that I use today when investing in stocks.
So, Chris, I've heard a story about you, and I'm interested if you can confirm or deny it. But did you used to ban yourself reading the AFR on game days?
Yes, that's true, because I like to be blank on game day when I was playing, to not really be thinking about anything. I found that if I was thinking about things, I was invariably playing bad football. And there was a time during the last uranium bull market when uranium was really on my mind, which would have been about maybe 2006, 2007. And I did find that during games I was quite distracted if I'd been reading Fin. So that was banned on game day, and maybe even the day before too, I think.
Wow.
There were a lot of rules during my football career, let me tell you.
Well, I just want to pick up on that. Controlling your emotions in markets is incredibly important, and not being able to do so can have pretty devastating effects on performance of your portfolio. And I guess remaining blank is probably not what you want to be doing when it comes to the markets as such. But how did you remain so, I guess, blank and focused on game day and block everything else out?
I think I used to have some triggers that would really bring me back into the game when I was drifting away from it. Things around watching, the centre bounce when the ball was bouncing and float in the air, really focusing in on the ball and the way it was wobbling in the air, and a few other things that would just sort of center me and bring me back to what I and the team were trying to do at the present moment. But there are a heap of similarities, or I think there are, between playing professional sport and investing. And managing emotions is a big part of it, and how you respond to mistakes. So football is a game of mistakes. Even when you play the best possible game, you still walk off the field and you've made truckloads of errors during the game, but you haven't held on to them. You've been able to move on to the next moment and fulfill what you needed to do. And, my experience with investing is much the same. I make truckloads of mistakes. Currently, I make fewer mistakes now than I did 10 years ago. But even, people 10 times smarter than me are still making lots of mistakes, but they invariably don't hold on to them, and they make enough good decisions that their investing's worthwhile.
So, Chris, you flagged it before that you have a particular interest in small and micro caps, and I don't think we've actually spoken to someone who has a particular interest or expertise in micro caps before. So maybe if we start at the beginning, how do you define both of those terms?
Well, I mean, a microcap stock to me is a sub $50 million market cap company. And then the smallest companies that are listed are shell companies. So they're the main companies that I invest in. But I'm not some people like to label themselves a value investor or a growth investor or whatever type of group identity they want to assign to their investing. And I try to steer clear of that. There will be times that I buy, companies that have a $500 million market cap if I think they're going to go up. But generally, by and large, my most comfortable area is sub $50 million market cap companies.
Why is that the case? What's so attractive about that sector of the market?
Well, I think there's the biggest opportunity there for asymmetric returns. And you'll hear fund managers speak about that quite often, that they chase asymmetric returns. And what they mean by that is that a company can't go to less than zero. In terms of shell companies, they've usually got an enterprise value of $1 million. So if they've got nothing else in them and no cash, they're still really worth $1 million, the fact that they're listed. So you could argue that's about as low as companies can go for a period of time anyway, assuming they can raise some capital. And the asymmetry comes from the fact that companies can go up by more than 100%. And it's much easier for a $2 million company to go to $10 million than it is for a $200 million company to go to $1 billion, because for the $2 million company to go up fivefold, they've had to create $8 million of value as opposed to 800. And that's a simpler task. So that's one part of it. The other part that I really like is that the counterparty, or the people that I'm buying shares off or selling to, generally aren't funds in that space. So if you look at investing as a competition between the buyer and seller, which essentially it is, I don't really want to be buying or selling off funds because they're smarter than me, they've got more experience, they're doing this as a full-time job. It's much better for me to be buying or selling shares to mum and dads that work full-time, don't have the ability to go and meet management, don't have the time to do the work properly. And if they're the other counterparty, then I'm more likely to have a better return.
And so are these primarily companies that are all listed, or do you also do off-market investing in this space as well?
I occasionally do some pre-IPO stuff, but I really don't like investing in private businesses because, as you can imagine, companies that are sub 50 million market cap, things go wrong all the time. Management aren't able to achieve what they thought they would. Things always take longer and require more money than expected. So when you're in a listed vehicle and things haven't gone the way everyone hoped, you've got the option to sell out and move on to the next adventure. But obviously when you're stuck in a private business, particularly as a minority shareholder, you're pretty limited in what you can do. So I generally put a really high value on liquidity, and as such, they're almost all listed companies.
So you flagged there the fact that a lot of funds aren't playing in this space, and there's definitely not a lot of research analysts closely watching these companies. I guess that makes the information gathering process a little bit more difficult. So what's your process when you're looking at these micro-cap companies? What are the key things you're looking for, and where are you finding that information?
Well, it's twofold. I guess a lot of reading macroeconomic newsletters, because companies in that space, or often that I'm investing, are really concept stocks. So the importance around the narrative is really important. And then I've got accounts with sort of 15 different stockbrokers. So they'll be sending through deal flow daily on capital raisings or IPOs. So often I'll come into the company through a capital raising opportunity, and it's really just sifting through that and going and sitting in on all the investor roadshows where the management presenting their company for prospective investors. That's really the crux of the process, and I guess networking with other investors and listening to what opportunities they're exploring.
So how many buy opportunities do you reckon you come across a year through that sort of process, Chris?
It's really lumpy. So, I might have a month where I don't buy or sell anything, and then I might have a week where I might buy 4 different things. So it's just dependent on what's coming up and what looks attractive. And they're all at very different stages of investment. Like often I might invest what you'd term a gardening stake, if you like a really reasonably small amount of money just to get a position in the company and start to follow it a bit closely and potentially build some form of relationship with manager and the brokers that are the lead brokers in that stock. And then as you get more comfortable with how the company's going, you might increase your investment or you might just say, no, this one's not for me and move on.
So, Chris, are you purely Australian focused when you talk about microcaps, or do you look at microcaps across the world?
No, pretty much just Australian focused. I've had some things that have been listed in Canada, and some of the companies I'm in are dual listed. But essentially, the universe is big enough here for me to look at, and there's very few markets where you can list, as a sub $50 million market cap company. AIM over in London's, you can list as a small company and the Canadian stock exchanges, but a lot of the companies that I would invest in would be classed as almost venture capital type opportunities overseas as opposed to listed companies.
So are these companies even generating revenue when you're buying into them? I'm just trying to, I guess, get the distinction between perhaps a small cap that, sub, 100 million or thereabouts. Where is that line drawn?
Yeah, no, some are generating revenue. Very few are cash flow positive. And there's a good chunk of mining stocks that are either exploring or developing. So obviously they're not generating any revenue.
Equity mine.
So I think the microcap world probably has piqued a lot of people's interest as you've been talking about it, because for a lot of people it's probably not something that they often think about. So do you have any examples of companies that you've invested in or didn't invest in over the years that are good examples of what microcaps can do and the opportunity for outsized returns that you were talking about earlier?
Yeah, well, I might not use any examples that I've done, because if they were good, I'll look like a douche, and if they were bad, I'll look like an idiot. And I prefer to not look like either. But one that sort of makes me look like both, I'll throw up, which was, after football I worked as an analyst at a venture capital company and had a good relationship with the CEO there, and he sent me through an opportunity to invest in GetSwift pre-IPO, and it was a pretty good sized ticket. You could invest pretty much as either of us would have wanted, and it was at 12 cents. And I did a little bit of work on it. I explained to him that I didn't particularly like it for a few reasons, and GetSwift then listed. It was a 20 cent IPO, not long after they raised that money at 12 cents. And after that, pretty much exploded until it got up to $4 in almost, I'm going to say it felt like a year or less. So that's a 30-something bagger. So
the dream.
Yeah. So amazingly, the relationship's still reasonably good with the CEO. I'm no longer working in the firm as an analyst, funnily enough. But GetSwift then ran into all sorts of problems and ended up, they'd raised, I think, $70 million or so. So they went back to cash backing pretty swiftly, and they had a few court cases and various issues that they had to and still are dealing with. So, and that's sort of symptomatic of this space. Like, I think you're really naive if you're investing in really small companies, sub 50 million market cap, and you think all or most or even a lot of them are going to end up being real companies. But it's not naive to think that there'll be, X number of milestones in the next 6 months or the next 12 months that those companies can reach that get them re-rated. And that's when you need to look at if there's some liquidity trying to sell out, as opposed to holding on for the dream. So, that's what venture capital investing is. People come in at Series A, and the company will have a set number of milestones that they want to hit before they raise money at a Series B round at a higher valuation. But the difference is in VC land, people can't sell out along that way as an investor, whereas you can with listed equities. So I like what I do, and it's good for me because it's my job and I can spend a lot of time doing it. If you don't have the luxury of time to be able to do it properly, I don't think it's a good place for people to invest. If you do and you've really got a heap of time to dedicate to it and are prepared to take a huge amount of risk, and go for it.
So, Chris, one of the words of wisdom that we often hear and read about in, investing more broadly is, let your winners run and cut your losses. Don't hold on to them.
Yeah.
Let's use GetSwift as an example. Looking at the stock chart here, and you're right, IPO'd and then jumped to $3, fell down again a bit towards the end of November, and then, spiked up to $4 and then absolutely fell off a cliff. If you were holding GetSwift during that period of, I guess, rapid growth, how do you think about exiting, or do you just let it run and then you're off a cliff?
That's what gave me a bit of comfort in that, is because I didn't love the story. Even if I had invested in it at 12, I would have been gone at 20 or 25 or,
right.
It's unlikely I would have held on for that long. Not because I don't agree with the sentiment as to let your winners run, but for me, it's let your winners run if you've got a really clear understanding of where they're going.
Yeah.
And they can go higher. It's not just an automatic rule. But for me, I'd echo those sentiments. So I lose on 52% of the things I invest in. I make good returns. I'm pleased with the overall outcomes because the winners are bigger than the losers. That's a really important concept. And even Buffett, I think Buffett hits on, is it 57% or 60% of the time?
Yeah.
So, that's sort of the best investor in the world. But if you get your ticket size right and you cut your losses early, that's incredibly important. But, so certainly averaging up rather than averaging down makes a lot more sense because average up once you get really comfortable with the management, they start to provide a track record of doing what they say they're going to do. So, I'd echo those sentiments. I think that's really important.
Well, Chris, we did a live show earlier this year, and one of the traders on the panel said they only hit on 30% of their trades. So you're smashing him out of the park.
Look at that! I look like Druckenmiller.
Yeah.
That's good.
So if we turn to the microcap world today, what are you seeing in the Australian microcap landscape at the moment?
Well, right now there's a huge amount of cap raisings coming through before Christmas, so it's a real rush. I think there's we're in an overall bull market, but it's a really pessimistic bull market. People are really negative generally on the economic outlook, and that's fair enough. But I guess I'm sort of just balancing up that, the broader economy looks pretty weak. Leading indicators about whether it's car sales or housing approvals look really soft, and general economic growth in Australia and overseas. But then interest rates are just so incredibly low, and you need to balance those two things up. And, trillions of dollars of negative yielding bond yields around the world, I don't think that's going to attract a lot of investors, and the money's got to go somewhere. So most people have no idea what's going to happen in the next 12 months or 24 months. I think the economy is going to be soft, but I'm not sure that that's going to be reflected in asset prices just because the cost of money is so cheap. And small caps have been reasonably soft. The big caps, the index funds are having such a powerful impact on price at the minute. And generally, the outperformance has been caused by, a few large cap names. So there's some pockets of froth, like probably the biotech industry and healthcare industry in Australia looks a bit frothy or a bit overpriced. But certainly there's not a lot of love for mining at the minute outside of gold stocks. And the microcap space more broadly is, I think, reasonably soft. I think people are off tech a little bit, and that's drifted down into small cap ends. So, I think I'm a reasonably comfortable buyer at the minute.
You mentioned a few sectors of the market there. What are some in the microcap space that you really enjoy sort of digging into? Please don't say mining.
Well, most of the stocks, like I mentioned, they sort of come under sort of various macroeconomic themes. So things like aging demographics, which is, a huge trend that's incredibly easy to predict, and it's relevant here, but relevant in lots of other places around the world as well. Clean air in China, automation, robotics, and sort of problems with fiat currencies are some of the things that are interesting. And then there may be sort of sector views where you might say something like an MBN doesn't appear to be going all that well, and perhaps some of the major providers of those services aren't as innovative as they are in different markets, and that might be a top-down theme that you look to attack as well.
So there's some themes that are interesting and have some good investment ideas under them. Are there any themes that you think are just trash and you reckon the market's got completely wrong?
No, but I mean, if you look at like the narrative or the story around those themes, it either is really hot or it may get hotter. Like, I don't think aging demographics has really exploded yet as a theme. Certainly the energy metals theme of 2017 around, nickel, cobalt, lithium, graphite for electric cars was a theme that really exploded. Those narratives cause capital appreciation. I guess the inverse is often true. Like when you've got a really bad narrative, the price compresses, and particularly if you're a yield investor, there are some opportunities that open up in that space. If you were to look at, say, retail property now is on the nose. Everyone thinks Amazon's going to take over the world, which they are doing in large parts. But sometimes those negative stories can create opportunities for investors as well. I'm not an investor in retail property, by the way. It's just an example.
Yeah, that's the one that I always go to when I think the market is just overhyping a story. I mean, Target's up 90% this year or something. There's good retail out there if you know where to look.
Yeah, Adair's had a really good announcement the other day. City Chic has done really, really well. Jacob's going well, as a retailer. So I get a little bit of insight there as well. But yeah, the offering's got to be good and it needs to be, a business that embraces all the technology in many ways is getting rid of a lot of the friction that used to be associated with retail.
So, Chris, you recently were hosting your own podcast, Masters of Markets, and now you've moved to a more video-based conversation with some of Australia's best public and private investors called Talk Your Book. I'm wondering if there are any sort of lessons or characteristics that you've noticed while doing these interviews that carry across the experts that you're chatting to.
Yeah, there are. I think the better the investor, the more comfortable they are being themselves, and they don't feel like they've got to pretend to be what an investor should be. I also think there's a bit of a correlation with the better the investor, the more comfortable they are speaking about their mistakes. I guess their track record allows them to do that. And the really good ones seem to just think about the world a little bit differently. I mean, every time you make an investment, you're effectively saying the market's wrong and you're right. So that's the Jim Grant line, that the key to investing is for the market to agree with you later on. So to do that, you've got to be able to think a little bit differently to everybody else, because if you didn't, it's a lot harder for you to say that the market's wrong and you're right, which is effectively what you're doing every time you buy a stock or an investment.
Similar to Bryce's question there, are there any key sort of skills or I guess tips that you've picked up from these interviews with some of Australia's best fund managers that you've then incorporated into your own investing style and process?
Oh, I think it's really important to pick a style that suits you. So there's not one right way to invest. There's thousands of different ways to invest successfully, but you want to pick a style that suits your particular skill set and your particular risk appetite. I think that's been one of the learnings. It's probably been reaffirmed when speaking to these different investors.
Why do you think small cap investing is a style that it suits you as opposed to the big end of town, the boring side?
I love stories.
Yeah.
And I think, there's the book written 21 Problems for the 21st Century. The author escapes me. The premise of the book is what's the most powerful thing in the world, and it's stories. And if you look at, the Bible or the impact of stories on the world, I think it's hard to argue with. So I like them, and I've got a really high appetite to risk, and I like reading macroeconomic research. So I guess most of the stuff I'm investing in, I feel I'm almost like a macro investor, but just choosing the least sophisticated counterparty I can find.
So on that, Chris, when people generally think about investing in sort of macro themes, they generally jump to the big end of town, I guess, and they, go to broad market ETFs and stuff like that. But you're talking about using macro themes and how the world's changing and investing in the smallest of the small companies. What's the interplay between sort of the big end of town and the broader market cycle and small caps?
Well, I mean, the big end of town, there's just not enough liquidity in small caps for them to play in it. So if you're a big fund manager and you like gold, you can't buy you might need to invest $50 million in gold if you're managing, a few $1 billion. So hard to do that in a small cap gold explorer or developer. You might buy the physical asset or a future or whatever. But, I mean, essentially, if the gold price goes up and appreciates, the explorers and developers do well, as do the producers. But generally, the riskier the asset, the better it will do when the price appreciates. if the price of gold's going up, you're much better off being in a high-cost gold producer than a low-cost gold producer, because the impact of the rising price is much greater on the high-cost producer than it is on the low-cost producer. I'm not sure if that answered your question, but that's sort of a way I look at it. And it does give you a margin of safety. You know, if you get something in your portfolio that does go up 4 or 5 times, there's a margin of safety across the rest of your decisions in your portfolio in a way.
So, Chris, I think we're just ticked over 40 minutes. So we want to thank you for taking the time and talking about microcaps. I think a lot of people it will have sparked an interest in. We like to wrap up with the same 3 final questions. But before we get there, I've got one last one for you. So,
yes.
As we mentioned, you're still heavily involved in the Carlton Footy Club. And across the world, there are a number of publicly traded sports teams like the Brisbane Broncos in Australia. So is there any appetite to do a similar IPO for Carlton?
There is zero appetite. Zero.
You should leave that.
You're essentially an operating unit of the AFL, essentially. So you've got limited control to grow your revenue, and your cost base is fixed. So I think it's that's a big pass from me.
Fair enough.
So
I'd be happy to sell into it.
So, Chris, the first of our final 3 questions that we always ask is, do you have any must-read books, investing or otherwise, that you would recommend?
Oh, yes. You know what I'm reading at the minute, which is really good, is Atomic Habits by James Clear, which is about breaking poor habits and forming good habits, but it's got a bit of relevance to investing as well.
Yeah, nice.
Do you want a quick narrative on one of his stories, which I think's useful for investors?
Yeah.
So he speaks about an experiment that a university lecturer did at school. So he was teaching photography, and he split his photography class up into 2, and he said to half the class, your job is to take as many photos as you can this year. I don't care about quality. Just go out there and take truckloads. And then he said to the other half of the group, I just want you to take one photo, but I want it to be the very best photo you can possibly do. It's all about quality. I don't want quantity. I just want one brilliant photo at the end of the year. And at the end of the year, all the best, or the vast majority of the best photos came from the group that was just out there taking truckloads of photos, because they improved their skills so much more than the other group that was just sitting around hypothesising about what would make a great photo. And I think that's got a bit of utility for investing. If you want to improve your investing, the best way to do it is to actually invest, as opposed to just sitting around talking about it. So it's a little piece that I quite liked from that book.
Couldn't agree more. One of the biggest messages we kind of get across the show is that there's no better way to learn than by actually getting in there and doing it. There's only so much paper trading you can do, but you don't understand, your emotional side and all that sort of stuff until you've actually got some skin in the game.
Yeah, the paper trading's not the same at all. But
No.
just know that when you start, you should be losing money, and if you're not, you're just being lucky rather than smart. In all likelihood.
Yeah, it's true. It's true, yeah.
So, Chris, the second question that we like to ask is, what is your go-to source for investing information?
Oh, I think Real Vision is the best content I consume, which is a US-based, it's mostly video content. They've got some written content as well. But I spend all day consuming it. Macro Voices is a podcast out of the States. I like all the newsletters from, Fred Hickey to Mark Faber to Howard Marks to Ray Dalio to, I could go on forever. So all that sort of broad-based stuff. I don't take a lot of notice of broker research reports just because they're sort of rubbish, really. They're just designed to keep their clients happy so they can get their corporate advisor fees when that company's looking to raise capital next. So I don't really consume much of them. But then I use Stock Doctor, which is a quick way to analyse financials of companies. So lots of different things. And then just talking to people as well is really useful also.
Yeah, we're big fans of Real Vision, and I think I'm joining the dots here. You've just ventured into video yourself. Fan of Real Vision. Are you trying to start something here in Australia? Or?
No, well, I think you'll know, if you're a Real Vision fan, that Scott Williams was just on Real Vision talking about Paradigm. Have you seen that?
No, I haven't yet.
So Paradigm, I'm sure you'd realise, is a stock we featured on Talkie Book only a few weeks ago. So it looks like if anyone's following anyone, it's probably me. Who's following Talkie Book is what that's what it looks like to me. But I'll let the other viewers make their own minds up on that.
Market leaders in video content.
You said it.
To wrap up, thinking back to when you received your $1,500 and made that first investment, what would be a piece of advice that you perhaps give yourself back then, knowing what you know now?
Well, if you're investing to make money and you don't know what you're doing, you start with an index fund potentially if you've got limited time, or then you go to a fund manager if you've got a little bit more time to research which funds are good funds or what you think are good funds. And if you've got a truckload of time, you can move down the risk curve and do it yourself. But if you're investing to learn, then there's no better way to actually do it yourself and to not... You know, the finance industry can be quite good at making simple things sound complex. So do not be put off by the various acronyms or the language people try and use to pretend that it's more complicated than it is. And the industry is not filled with geniuses, but it is filled with people that do this thing day after day. And it's that experience that if you can start to do that yourself, then, you know, there's no reason why you can't make some money.
Awesome advice. I think sort of certainly applicable to everyone listening to the show. So appreciate those words, Chris. And very much thank you for coming on the show today. As we said at the start, third time lucky, but very much enjoyed hearing your thoughts on small caps. It's something that we haven't been able to go into detail with any really expert investor along our journey. So appreciate it. We're kind of fanboying over here at the moment.
Thanks, guys. It's been a lot of fun. I've enjoyed it.
And if anyone wants to find out more info about yourself or even Talkie Book Masters of Markets, what's the best place to do so?
The Chris Judd Invest channel on YouTube or Facebook, where all video content will be put up, or chrisjuddinvest.com.
Nice. Well, check it out if you're keen to see more of what Chris does. And yeah, Chris, thanks for your time.
Thanks, guys. Much appreciated.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mate.